Hey, what's up everyone and welcome to the School of Personal Finance. So I've been watching a ton of videos on getting out of debt, on velocity banking, the debt snowball, the debt avalanche, and really what works the best when you have debt that you are trying to pay off as fast as you can. And one thing that I've noticed is there's a lot of confusion with how payments are applied to different types of loans and how interest works. You hear a lot of terms like front loading of interest when it comes to mortgages, and it just seems like there's a lot of misunderstanding out there. So in this video, I'm gonna go over the different types of loans, how interest works to help you understand. So if you want to get out of debt, help you attack it in the best way possible. All right, let's get to it. If this is your first time here, my channel is all about growing your net worth, paying off debt, investing for your future, protecting your family. If you're interested in those topics, please make sure to subscribe and go check out schoolofpersonalfinance.com. All right, so let's start off by talking about mortgages. And I'm gonna share my screen and we'll look at a mortgage calculator. All right, so this website is just calculator.net and it's a mortgage payoff calculator. So I put in here $400,000 original loan amount, 30 years, 6% interest, right? You have 30 years remaining on it, and we are just gonna do normal payments. So as you can see, in this first month, right? They owe $400,000. The interest rate is 6%, so that's $24,000 a year. Divide by 12 in that first month, right? 12 because the number of months in the year. So the first month they owe $2,000 worth of interest. And you could see for the amortization schedule, the monthly payment is $2,398.20. That is not going to change. That monthly payment is going to stay the same the entire time. Even if they decide to throw a chunk of money to paying off the mortgage faster, that monthly payment is going to stay the same. What will happen is if they throw a chunk at it, is it will cut time off the back end. They will pay this off faster. But in this case, no prepay, no throwing chunks at it or anything, right? We're just going to look at these first few payments. So $2,000 goes towards the interest, $398.20 goes towards the principal. So then we could see after the first month, right? This $398.20, it paid down the principal. So now we're at $399,601.80. And now the next month, in order to calculate the interest that they owe on here, we're going to take this dollar amount, this $399,601, multiply it by 6%, divided by 12 months, and the new interest payment is $1,998.01. So the rest, the remaining amount of their monthly payment of this $2398.20 on top of the interest, that is going to be the principal amount. So that will reduce the balance over here. Next month, same exact thing. They're going to take that new balance, they're going to multiply it by the 6% interest rate divided by 12. We have our new interest payment. So as you can see, it's just going to keep on following the schedule. And as you continue to make payments, the balance is going to continue to go down, which in turn is going to make the amount that you owe in interest every month go down because you have a lower outstanding balance. And this will continue until you're done with the loan in 30 years. So now people say the interest is front loaded. You owe more interest in the beginning because that is when you owed the most money. So if you didn't want to front load the interest, right, what you could do is you could pay off half the loan in the beginning. So in that case, a lot more of your payment would go towards paying down the principal because your interest charges would be less because you would only owe half of the amount that you started with. Actually, let's just do that. Let's just look at a quick example of doing that. Right, so here they owe $2,000 interest in the first month, which we calculated. Let's say that they throw $200,000 at it in this first month, and we'll see what the difference is in the interest payment. So we could do repay with extra payment. We'll do a one-time payment, $200,000 right out of the gate. All right, so we can see the difference right here. They show it right in the table. So with the original amount, right, we just made a regular payment in the second month. Our interest is basically the same, right? It only went down a couple bucks. It's $1,998. But now with throwing 200 grand at it, right in the first month, you could see that the interest payment, it has gone down by $1,000 in that second payment because they owe half the amount, they owe less money, right? And you could do the calculation. So the ending balance here is $199,601.80. If we take that number, we multiply it by 6% interest, divide it by 12, that is where we get this interest amount of $998. And they still need to pay $2,398.20 each month. So now anything above the interest amount is going to go towards knocking the principal balance down. And then they'll do the same calculation. So yes, if you throw owe a chunk of money at the mortgage in the beginning, you will save a tremendous amount in interest costs over the life of the loan. The issue is you need to have that 200 grand to be able to throw at the mortgage to be able to knock down this amortization schedule. But you have to realize it is just the savings on that amount of money. There's no magic that happens, all right? You are knocking years off of your life. You're knocking, thousands, tens of thousands, hundreds of $1,000s off the interest charge, but that is because you now took this 200 grand that you had access to and you used it to pay down the mortgage. So the question would then be, where did you get this 200 grand from? Because that 200 grand, what if you could have earned 7% on that 200 grand? Then would it have been the right move to take it and pay off this 6% mortgage where you could earn 7% on the 200 grand? And the answer would be no. Now I'm just making up fictitious numbers, right? It's basically impossible to earn a 7% guaranteed fixed rate of return these days. But just making the comparison, if you were able to do that, then you would be better off keeping your money, earning 7% and paying 6 over here. And then you could just use the interest to basically pay over here, and you would have some money left over by earning more money than what you're actually paying. All right, so let's just look at this chart right in the middle here. So total payments, if you just pay it over the 30 years, $863,352. So interest, $463,000 you pay in interest. And you're probably thinking to yourself, holy cow, I just paid double in interest of what I actually borrowed from the bank. The bank really ripped me off. But that's just not the case. It's really just math. If you want to borrow 400 grand at 6% over 30 years to pay it back, you're going to pay a lot of interest, right? You owe them 400 grand that you're starting out with, and you're spreading the payments over 360 months. So it takes a very long time to pay that back, and the interest, it accrues over all of that time. And it's just simple math. So if you don't want to owe them that much in interest, the only solution is you give them bigger payments every month. You pay down the loan faster, or like we just showed in this example, you take a big chunk of money and you throw it at the mortgage early on so that you really pay it off much faster, because if you have a lower balance on the mortgage, then more of your payments are going to be going towards principal, right? It's going to knock down the mortgage and less will be going towards interest. But at the end of the day, it is purely just a mathematical equation. All right, so now let's just quickly look at the same scenario with a 15-year mortgage. So 400 grand, 6%, 15-year mortgage. And as you can see, in month one, the payment, it's $3,375. So the payment, is $1,000 more than on a 30-year, right? So you have to have the cash flow to be able to afford a $1,000 a month higher payment in this situation. But the interest is still $2,000 in that first month, right? It's math. You owe 400 grand, 6%, that's 24,000 bucks divided by 12, $2,000 in that first month that you owe. But now, because you're paying more, you're paying like $1,000 more a month, you have more going towards principal. So in this scenario, $1,375 is the principal payment, and that reduces the balance. And then the next month, same exact calculation, right? You take that $398, $624, multiply it by 6%, divide it by 12 months, and you have your interest payment for the second month. And then anything above that is going to go towards paying down the principal. And you just keep on going through paying the amortization schedule, and at 15 years, you will be done with it. So as you can see, the amount of interest that you owe, it is a mathematical equation. The bank is not front-loading interest. It's just in the beginning of the mortgage, that's when you owe them the most money. So you're going to pay the most interest. And the longer you spread it out, the less that's going to principal. So now you're not really reducing the balance of the loan. So the interest payments are going to be very high in the beginning until you start to make some headway and reduce the principal, which takes a long time if you spread the loan out for very long. All right, let's quickly look at a car payment. So now with a car payment, if you do a 36-month car payment, right, that's only 3 years. That's a short period of time. So obviously you will pay much less interest over 3 years compared to if you finance it over 30 years, right? But your payment is going to be much bigger on the 3-year loan compared to a 30-year loan, because you got to pay the thing off in 36 payments. So in this example, we're going to do a $50,000 car loan over 3 years, 8% interest. All right, so the monthly payment is going to be $1,566.82. And it's very similar to the mortgage. It's just an amortization schedule. All right, so in this first month, we're going to calculate how much interest they're going to owe in this first month. We take the 50 grand, right, times 8% interest, which is basically $4,000 of interest over the year. You divide that by 12 and you get $333.33 in interest payments for that first month, right? But now your monthly payment is $1,566.82. So the amount above this interest payment is going to go directly to pay down the principal. And then it's the same calculation next month. We got the $48,766 is the new balance, right? We're going to multiply that by 8%, divide it by 12, and we have our new interest payment for month 2. And you can see on the total of 36 payments, you will have paid $6,405.46 in interest over those 3 years. All right, so now let's compare that to the same exact scenario, but it's a 6-year car loan. So $50,000, 6 years, 8%, all right? The monthly payment is going to be much less because now you're spreading it out over 6 years. All right, so the monthly payment would be $876.66. Now, the interest for your first payment, can you tell me what it's going to be? All right, it is going to be the same as if you did a 3-year mortgage. Why is that? Because in the first month, you owe the same amount of money and the interest rate is the same. So you owe $50,000, the interest rate is 8%, right? So $50,000 times 8% interest, that is $4,000 for the year. Divided by 12, that's $333.33. So the amount that's going towards paying down the actual loan that they owe to the bank is only $543.33. So now this is just going to continue. So as you can see, it's going to take them much longer to pay off this loan because they are making a smaller monthly payment every month, right? The bank is not front loading the interest on this one compared to the 36-month one. It's just their payments are less every month. So the outstanding balance is not going down as rapidly as it is when they're making those bigger payments that are going towards principal. So I hope that this is making sense to you. So if you want to pay your mortgage off faster, or you want to pay your car loan off faster, the way that you do it is by paying more towards the principal, because by reducing the principal, that is in turn going to reduce the amount of interest that they're charging you, because again, it is just pure math. Right? The less you owe, the less the interest charge is going to be. And if your payment stays the same, that means more of your payment is going towards the principal, towards paying down the amount that you owe them. Hope you found this one helpful. I'll see you again in the next one. Please leave a comment down below. Let me know what you think. I'll see you again soon. Thanks. Bye.